Good evening, everyone. Time for another silver update. This is the 2-hour chart of silver provided by netdania.com. You can click on the link below. I've drawn a few trend lines in here. I want to make a point about the rollover from downtrend to uptrend. So the first thing to notice is this current uptrend line that I've drawn here. I'm trying to draw a comparison in with the MACD. You can see from the bottom point when we got the MACD buy signal, I've drawn this line up to the current price that we're at, and I've drawn to the bottom of where we are right now. So the first thing that stands out at you is this, how steep the slope is and how little we've corrected in price, as I pointed out yesterday, as far as corrected in the MACD. So that's going to be that differential there. Now the other one is going to be when we were on the downtrend. You can see how steep the slope down here is compared to relatively how steep this MACD descent is. So it's kind of a mirror image, and the upshot of this is that this could be the turning point, and that's what these two blue arrows are about. And that's that you can see this big divergence here in that where the MACD made this low, this is the critical low here that marked the buy point for the bottom of this period of time that we're looking here. And this spans roughly the beginning of April through today, so about a 4-month period. And you can see that the bottom was clearly made at this point, but you can see that the price bottom was not made. The price bottom was made here, and we have this other MACD point. So that's the big divergence point, and it's not surprising that we get a MACD divergence with price at the point where the MACD sell signals stop working and the MACD buy signals start working. And so again, the issue we're looking at here is if the MACD can round up from here and go up. I can't get my arrow to go up here, but if we go up from here with this very little price correction, then that will be a confirmation that this divergence in the MACD, and you can see that one is going down and the other is going up, if this divergence really is the bottom. And of course we have to go way out to see what that will mean, and that's on the weekly, and we're looking for the bottom, such as this type of a bottom here. If this is the bottom, and of course I thought this was the bottom, but we came down again, then we're going to form a W type formation and go straight up from here. So hopefully that is an indication that we are at the bottom, and there isn't any more downside to go. Of course, if you're a stacker, you probably want more downside. You'd probably love to stack at 22. If you understand and believe the fundamentals, then you would love to see lower prices. I don't think you're going to get that chance. So on to the questions of the night, and we're going to start with, there's a number of them, and I can't go into depth. There's just too much to cover, but the first one is default on loan to ourselves. This is a video that was on RT. I think it's from 2008, and this is with Michael Hudson, and it's from May Joe. The question is, it never occurred to me that if we default, we are defaulting to ourselves or at the most to a small private company. How much money does America owe to other countries? Way less than the central banks, but how much exactly? Probably a very manageable amount. So I'm not going to play that video, but it's Michael Hudson, and basically he's saying that we owe it to ourselves. And I'm going to go to the next question because I'm going to cover the issue when I go to that. Now this one is the USA is not in debt, and this is from George Silver. Dear Brother John, knowing how you like to dissect specious arguments, I thought you might enjoy this article. The USA is not in debt. There are many sites on the internet that like to think they hold the truth. The problem is they're like a pitcher plant and lure their victims in by clever arguments until a slippery wall of brainwashing traps their victims. So he gives that link, and this is the link here, and it actually posted today, the 28th, and that's the USA is not in debt. And this is the similar argument that's made by Michael Hudson, that we owe the debt to ourselves. So I'm just going to go down to the bottom and summarize, and then I'm going to give my counter to this. There you have it. To pay for the lost payroll tax money is transferred from the general fund, meaning the U.S. government simply creates the money. How? I said the federal government does so by selling treasury notes, but even this is an illusion. The general fund, the Social Security Trust Fund, and all federal funds are accounting fictions. They do not exist in any real form. They are nothing more than numbers on balance sheets, wholly under U.S. government control. The dollars may seem real and scarce to you and me. For a monetarily sovereign federal government, dollars are an accounting fiction. They are mere numbers the government manipulates at will. Need $1 trillion to pay for Social Security? No problem. Credit the general fund by $1 trillion and debit the Treasury security account. Need another trillion to pay for Medicare? No problem. Credit the general fund and debit the T security fund by another trillion. Need more dollars in the T security account? No problem. Credit the T security account and debit other accounts at the Federal Reserve Bank, which keeps all T security accounts. Dollars are an accounting fiction wholly controlled by the government, which can create an infinite number of them simply by crediting accounts. The government can credit Medicare, Medicaid, Social Security accounts endlessly, just as it can credit all federal agency accounts endlessly. The government creates money by simply making an electronic accounting entry. It can do this forever, or until no one will accept these created numbers as having any value. The only way Social Security or Medicare or any federal government program could run short of dollars is if the U.S. government decides not to credit the program's accounts. Such a decision would be purely political, i.e. done to further empower the 1%. So, again, another left-wing analysis, and clearly false. First of all, the key false assumption here is that the Federal Reserve is the government. The Federal Reserve is not the government. The Federal Reserve is a private bank that has shareholders, the majority of which are foreign owners of that bank. So the U.S. government borrows money from the Federal Reserve. The Federal Reserve creates money out of nothing through its fractional reserve accounting system with the bank. So that's the first false assumption that this author has, and the other authors who have this left-leaning view. The other false assumption is that there's no consequences to the printing of this money, and that's because the dollar actually is traded on a foreign exchange, and therefore there isn't a limitless amount of dollars that can be printed unless the other central banks of the world can be convinced to print equal amounts to keep the dollar from falling. So those are two really critical arguments. That the U.S. Congress has ceded the power to control the money supply to the Federal Reserve, a private corporation, and that's to their eternal shame of the U.S. Congress for doing so. As you know, Kennedy and others had tried to take back that power from that private entity and give it to the government, which in my opinion probably wouldn't be any better of a solution, because politicians can't be trusted with that power either. Obviously the answer is going to be a market-based system where I don't believe governments at all, whether they're local, state, or federal, and we're going to see this when we look at the main story of the night. I don't believe that any government should be able to borrow any money at all, period. that governments should have to fund whatever they do through taxes, and if those tax revenues aren't available, then they shouldn't be able to do what they want to do. So government should be funded in real time by real tax revenues, and they shouldn't be able to run up massive debts. But that's not the situation we have, and this view is not the situation we have, or a correct view of the situation we have, because the bankers are a private corporation, and ultimately it's my opinion that their goal is going to be to just simply print enough money to buy everything, literally to buy the entire world, and then the bankers will simply own everything. So hopefully that clears that up a little bit. The left-wing argument that, and basically all leftists believe this argument, that there's a money tree in the backyard, and what they're proposing is that the money tree isn't controlled by the right people, or they're not pulling enough money off the money tree. But obviously people who study economics understand that you can't have everybody sitting retired. You can't have everybody living off of the government, because then nobody would pay the bills. It doesn't really matter what type of currency you use. If nobody's working and everybody is retired, we'll just use that term to mean living off of others. If everybody is retired and nobody works, then obviously there's no wealth being created, and that system will collapse. So it doesn't really matter how you describe it. There has to be a certain number of taxpayers, and they have to support the tax consumers. We're going to see that when we look at these charts. So let's get over to the charts. I want to cover this, what I'm going to call endless recession. And this first chart here is the United States unemployment rate. The first few charts I'm going to cover are charts that are official charts, and when I say that, what I mean is these are charts that use the official statistics, and these are statistics that can be bent or kind of molded by the government to paint a better picture. So I picked the worst ones of the official statistics to show you that this recession is quite different and much worse than other recessions. The first chart here is the official unemployment rate, and you can see we've never dipped below 8% on this unemployment rate. Now, not to get into politics, because it's something I try to studiously avoid, but just based on his promise, then obviously Obama has to be sent out of office, because we never even breached the 8% level during his entire administration. And that's really surprising considering the amount of stimulus. We're going to see this in the other charts. But this is clearly a different scenario than any other scenario, whether it's the 80s recession, and if you remember the 80s, we had a double dip, and we had the 90s recession, and we had the 2000 recession. But this recession is a stubborn recession that really won't go away. The next chart is United States government debt to GDP, and you can see that the problem became very bad under Bush and accelerated under Obama, and we went from roughly 70% of GDP, debt to GDP, to over 100%, and it's not improving at all. And of course the economy is not really improving at all, so one would have to ask, where did that money go? The next chart is U.S. consumer confidence. Now you can see that this one is not as long of a time frame, but you can see in 2008 consumer confidence basically dropped off a cliff as we entered into the financial crisis, and you can see it's never really recovered. It's recovered from the low, which was below 30, but as far as its recovery that it did in previous recessions, we're pretty much flatlined around 60-something%. So consumer confidence really has not recovered. But again, these three indicators are just official government statistics, and they can be massaged. All the government statistics can be massaged, but the ones I want to look at that can't be massaged very easily are the key ones that are going to tell us where we're at. And the first one is the labor force participation rate. Now this is simply a number, the number of American citizens who have jobs, and that's put over the number of American citizens. So it's not a difficult number to understand. It's just simply the percentage of Americans that are working. And you can see that this labor force participation rate has consistently declined since the beginning of the financial crisis. We're down to about 63.7%, and you can see that we're beginning to turn down again from this high of about 66%. Now we're on the 5-year. Let's go out to the 10-year. So you can see there's really no recovery, and in fact, even before the downturn, there was no upturn. It was just a sideways movement during the Bush years. I can't go out to the max because that's a paid service, but pretty much during the Bush years it was a sideways movement, and under Obama it's pretty much straight down. Now this makes sense because the stimulus under Obama has been make-work government projects, which really don't stimulate employment except for the existing government workers. So you can see that even though the spending has gone up, if you remember the debt figure that we showed you, the employment numbers, the numbers of people employed in the economy, have consistently fallen as a percentage. So that's one of those numbers they can't fake. This is a chart you need to really keep your eye on, because this isn't something you can fake. This is the raw number of people as a percentage in the employment market, the U.S. labor force participation rate. Now, the next number they can't fudge is total direct revenue. This is just simply the amount of taxes the government collects in dollars. So even though the government might print money and borrow money and stimulate and do all kinds of crazy things to try to revive the economy, and even claim it's revived when it's not, these numbers don't lie. This is the amount of money the government takes in from taxes, and the amount of money they take in from taxes are composed of revenues from income tax and corporate taxes. So those are straight dollar figures, and they can't really fudge those numbers. Now you can see here this chart goes out to 2015, and what's interesting is that these are projections from about this point here. So they're projecting, and that's what you see with government figures all the time, whether it's the budget deficit or the revenues or any numbers the government puts out. They're always supposed to get much better in the future, but they're bad now. But they're going to turn around as soon as the people who are in office right now, which might be held accountable for the bad numbers, manage to escape with their golden parachutes, and it goes to the next guy's watch. But then the numbers are going to be a lot better. But you can see here, we're at 2012. We're actually right at this point. So if you draw a line down from the top of the total revenues, we had a top actually right at the top of the NASDAQ bubble. And then, of course, they collapsed all the way through the 9/11 incident. And then the rally from there with the Fed lowering rates drastically and pumping tons of money into the housing bubble, and then the crash. And then, of course, a huge stimulus under Obama and under Bush, and tremendous printing of money, QE1 and 2, and we're up to here, and then we're just sideways to right about here. So that's the last chart that shows you that really, and of course these projections aren't going to come true, so we're going to probably turn down from here actually if the past holds true. So there's an example of another chart that shows you the true picture as opposed to the fake government picture of the way things are. We are really in an endless recession, and it's my opinion that things will probably get much worse from here. Will that impact the price of silver? I don't think so, because you have to remember that the silver prices are impacted by world events, not by U.S. events. And a lot of the events going on in Central and South America are the tightening of supply, and then the events going on in the East are the increasing of demand. So we're seeing increased demand and tightening supply, and of course that's going to lead to much, much higher prices in the future. And we'll talk to you next time.